let's talk about what we're going to, the economic situation we face in this business today. A snapshot of today's presentations: lower but not low cost. Okay? Now, that's kind of like the difference in pain of hitting yourself with a 5-pound hammer and a 2-pound hammer. They both hurt, but one of them hurts a little less than the other one. We had an excellent planting season this year. We did have lower than expected acres, especially for corn. We had declining conditions since June. Very wet conditions in some place. I lived near Des Moines, Iowa, the little town I live in. I don't live in the floodplain, but we're putting up all the sandbags and the flood barriers again today. Record yield and crop and usage for this year. Okay? And that's the key. It doesn't matter how much you raise if you use all of it at high prices, and that's really what is happening. On the hog price side, we have recovery. The prices have been better than I expected they would be this year. We've had lower supplies, especially since June, than what the June Hogs and Pigs report said. We'll talk about specifics. Strong wholesale and farm demand. It's been excellent all year, but then we have to balance that. Have been some conflicting signals from the retail sector that it really hasn't been very strong according to the data we have. We've had help from competitors, especially in the first and second quarters of this year, with near record chicken prices and $160, $165 cutouts on choice beef. Both of those are waning a bit, but I think we're still going to have pretty supportive situations with competitors going forward. Short-term factors to consider. Well, first there's weather. This crop is not made yet, and it's actually deteriorated. One of the things in yesterday's crop report that nobody talked about is at some point we've got to come to grips with we're going to have fewer harvested acres on corn especially. Maybe 1 million. All right? Now, 1 million here and 1 million there, and pretty soon you're talking about real numbers of bushels. But 1 million fewer acres would lop 160 million off the crop at the rate that we got to put in at, and that would take year-in carryouts down to 1.2 billion, and that's a pretty tight number. Economic problems in Europe, those had their major impacts on kind of the confidence in the recovery. They did impact the U.S. versus Euro exchange rate, but that's really the only exchange rate that they had a big impact on. Domestic demand, of course, still a little shaky, this recovery. We could have a double dip. We had increased unemployment filings again last week. So it's really not a very solid recovery. Quick supply response to profits. I mean, that's been kind of the concern of the pork industry all spring was, boy, we're making money. Now who's going to start putting in sows again? We'll talk about that. And then finally, any number of goofy occurrences that could happen. And the example I give you is H1N1. Steve, I think a year and a half ago you may have been in the meeting when the pork board was doing a strategic planning exercise, and they had gone through and thought of 83 factors that they thought were really important on one of those graphs that says, the probability of it happening and the impact if it happens, and so you divide it into quadrants and all that. Not one of the 83 was a human influenza. Not one. And that was 3 months before it happened. I don't mean that to throw rocks to people that were doing it. It was just that it wasn't on anybody's radar. And there could be some other one out there that's not on our radar. So you need to make sure you kind of give that some thought. Grain and feed cost outlook issues. Record early corn planting has certainly got this crop off to a good start. Now, one point I will make. There is very little correlation between when a corn crop is planted and the yield that you get out of it. There's too many other factors. The only thing that really does is it probably takes an early frost out of the equation. So we're probably okay on that, but from there on, there's lots of other factors. Weak ethanol margins have not been very supportive to corn, and so it's getting support from other places, and one of the big ones recently is the third one. Russia, Kazakhstan, Ukraine wheat crop certainly have driven prices higher, and it supports corn. Last week's explosion was certainly overdone. If you look at the charts, it was, here we go up, and here we go back down, and now we're kind of right back in the trading range we were prior to last Wednesday. So it was really overdone. It's still supportive to corn and beans. The report yesterday, higher yield and production than the estimates were, even the analysts' pre-report estimates, and yet prices rose. I mean, they did not represent market sentiments, or this was a real surprise in some other way. Corn planting, of course, like I say, was the fastest we've ever had. Very quick planting crop. pushed these prices down into June. Those lows, though, were in the 350 to 380 range on December and March futures, and as of yesterday, those were trading at 421 and 431. So, just because you get a big crop planted and you get it planted quick certainly doesn't mean cheap corn. Now, these might be hard to read. I'm glad we got a big screen. But here's yesterday's crop report. The numbers out of that, a number of them went larger crop, record yield would be the forecast now, but higher non-ethanol use. They left ethanol the same. They left feed and residual the same. But notice this one. They pulled down the carryout for this year by changing some usages. And so when we got to the bottom, we got 1.31 billion bushels projected carryout at the end of 2010-11 crop year, next fall. That's the that's the smallest one in 4 years. And if we look at the stocks to use ratio of only 9.7%, that's the fourth smallest stocks to use ratio since 1970. So even though we got a big crop, this thing is not a very solid situation from a supply standpoint, and I think you're going to have very high prices, and I'm not sure USDA's got theirs high enough yet. Here's where USDA's projected yield range is right now, 9.7 on stocks to use. The red line, here's the price, and you can see we're very close, not very far off from the record highs. If we look at it from a cash corn standpoint, we're in the top half of the kind of normal range that we're going to trade in now of $3 to $4 or $4.15. If we look at corn strategies, I think, given where we are on hog prices, high-priced corn won't kill you. Very high-priced corn still could. And so I think in this new day, I think one of the things you're going to need to do is look at possibly buying out of the money calls that protect you from $5 corn virtually every year, and maybe take some risk within that. Obviously, you need to start early on this. We've seen the low for the corn market, I think, for this year. But still, it's been going up through harvest in 3 of the last 4 years. Having physical corn in hand is always advisable. That through 1.31, I got 2.6, it should be 1.2 billion bushels, is going to get a bit snug for next summer. I don't think it's going to be a real bad situation, but the time is coming when we're going to get into summertime and you're going to go, oh my gosh, where am I going to get corn to get to September? Okay? I think there's going to be some issues of that in some areas. Okay, on soybeans and bean meal, we've hit a much larger crop, a record crop here, tying the record for yield with last year at 44 bushels per acre. They didn't change very many numbers here, a little bit higher on total supply, a little bit higher on crushings. Exports up about 65 million bushels. 360 is the carryout compared to 160 this year. I mean, this carryout is not much better than we were a year ago. 4.8% on stocks to use. We're going to double that next year. So, still beans $8.50 to $10, meal in the upper 200s range on USDA's forecast, and I can't argue with either of those. If we look historically, here's where bean meal has been, and of course we've got in these tight supply situations the last 2 summers that have driven bean meal up to $400, $425 a ton. Now, I don't think we're going there this summer, but it still could get pretty tight until we get this bean crop started into the bins here in September and October. So I'd have my bean meal bought here at least until we get into new crop. Now, here's where futures are. $260, $270 to $300, $280, $290 is the futures market for corn right now, for bean meal. Again, in the lower half, kind of toward the top of that lower half, but in the lower half of this new trading range of somewhere between $250 and $350. So, factors to consider. If we have continued rain, and we've had a lot of sudden death syndrome in beans in Iowa reported in the last couple of weeks, I guess I'm going to say, can prices go lower? I don't see a lot of potential for that with this crop. A slowdown in the torrid export pace could do it, but I think that appears unlikely. China has been very active in the market. 2011 prices, of course, when you get past March, you've got to deal with the Brazilian and Argentine crop, and at $8.50 to $10 US on beans, they're going to plant plenty of acres. $250 meal is very, very likely gone. I don't think you're going to look at that, but the futures are still, again, in the bottom half of that trading range, and maybe you need to take some of those positions. So I went through some calculations this morning and said, okay, what if we take this new range of $3 to $4 and bean meal of $2.50 to $3.50, and let's just pull some numbers out of it and run it through my Iowa State model, and it says at $3 and corn and $2.50 soybean meal, you're going to be about $61 carcass weight break even. If you get to the middle point of that, you're going to be at 66, and at the top you're at 71. And the point I thought was, well, since 2006, we spent a lot more time in the top half of that range or beyond the top of those ranges than we have in the bottom half. And it looks to me like a good rule of thumb for the foreseeable future is when I can buy corn at less than $3.50 cash in the Midwest, and I know that's you got to translate that to North Carolina, and bean meal at less than $300 a ton, you should probably be booking part of your supplies at those kind of levels, and hope you're wrong on those. I mean, because they're going to probably be some of the cheaper ones you get, and they put you in a cost position that leaves you competitive in the marketplace and probably, at least for what's offered in the futures right now, profitable. Last time I checked, you couldn't go broke if you was making money. Okay? Now, this current administration may change that, but at least that was the rules before now. I just want to make a point. I'm a member of no organized political party. I am a Republican. Now, to give credit where credit's due, Will Rogers made that line famous in the 20s talking about Democrats. So that goes back and forth. Last point I want to make is about DDGs on the feed side. DDGs have historically priced themselves out of hogs' diets in the wintertime. And the reason is they're darn good cattle feed. And when we start having to feed cows on grass and we put more cattle in feed yards, we've driven up the price of DDGs relative to corn, and they've priced themselves out of hog diets. Notice that did not happen this year. And my thinking is that it will not happen again, at least for the foreseeable future, because we're producing too dang many of the DDGs. And so we're probably going to keep them competitive for hog diets year round, which is good because I know you don't want to put them in and pull them out and put them in and pull them out. So I guess it's just a point that if you're not using DDGs, you probably need to figure out exactly how you go about that. Work with your packer to make sure you're not causing any fat problems on hog carcasses, but it doesn't look like these are going to price themselves out of hog diets in the immediate future. Any questions about feed, grain, whatever? Okay? Not great, but not a disaster. That's, I guess, the message on that. Okay, summary on hogs. Hog supplies have been 2.5% or so lower than what we expected out of the June Hogs and Pigs report since June. They've been almost 5% lower than they were a year ago. We've certainly cut back supplies. Now, part of that was our own doing, and part of it was just the way things have worked out with corn quality and other things this year. But still, we're running fewer hogs than we did. Prices have exceeded levels consistent with supply changes, which means that we've had excellent packer demand for hogs this year, and that has been generated really at the wholesale level, where we had some excellent prices for wholesale cuts, including record high prices for fresh bellies a couple of weeks ago. We've had conflicting signals. These near record cutout values and hog prices and the strong packer margins. That usually is a conflict. We don't see that happen very often. It's a good thing when it does. Everyone makes money. We've had okay exports, at least through May, and actually May and June has been pretty good. We'll talk about that in a minute. But we've had very soft consumer level demand in the United States. So these have kind of been a mishmash to a degree to make decisions, but the bottom line is hog prices have been good, and so that's good for you, no question about that. Feed cost outlook is positive for profits, but not nearly as positive as it was in early June. One of the things that when people have asked me, well, what about people putting sows back in? I've said, well, I think everyone's going to wait and see what feed's going to be first. And back in early June, I was thinking, well, we're going to see sows start rolling back into some of these barns, but now I'm not so sure as this feed cost situation has deteriorated. We've seen few signs of expansion yet. Sow slaughter is low. 55,000 head a week on sows is not very many. But as a percentage of the breeding herd, it's not abnormally low because the breeding herd is small. And if you got smaller pool to draw from, you're not going to be able to kill very many. In addition, gilt slaughter has frequently been above the equilibrium rate of about 49.5% of total slaughter. Anecdotal evidence of some expansion. I've heard some talk of that, but nothing serious, and I don't know of anyone that's really going. We've cut about 475,000 sows over the last 20, I guess that'd be 30 months. And that, some people at a meeting earlier this spring said, we think a quarter of those buildings could get repopulated. That would be about a 2% sow growth if you put that 120,000 sows back into production. I don't think we've really even started on that yet, so that's good news. If we look at chicken prices, of course, I talked about competitors. That's positive, very near record. I mean, it's gone down the last few weeks. Notice, though, that this scale is really pretty narrow. That looks like a huge drop, but it's only about 7 cents a pound. Okay? Not insignificant, but certainly not anything falling off a cliff of any sort. If you look at cattle prices, of course, cutout values are trending upward. Well, we've had the smallest calf crop in 50 years last year. We're going to have a smaller calf crop this year. We're reducing the cow herd at an almost alarming pace this year, given the fact that we don't have any real grass problems anywhere in the country. It's just amazing how many beef cows we're selling and slaughtering this year. And so cattle supplies are getting tighter over the next couple of years. I think you're going to see record high or very close to record high cutout values here within the next 12 to 18 months. So those are going to be positive. They've both been positive this spring. They're less so right now due to two factors. One of them is beef seasonally falls off at this time of year. The second one is the chicken business has started growing again, and so their prices are falling a bit. But still, I think both are going to be relatively supported. Some trade developments will certainly help chicken. They've had this deal with the Russians supposedly for 4 or 5 months now and signed for over a month, and yet I don't know of a pound of chicken that has gone to Russia yet from the United States. So if they ever start getting some exports going, that could be certainly positive for chicken, and it could help chicken prices, and that in turn will help hog prices as well. The state of the industry. I characterized to a group a couple weeks ago, wounded but still here. I think that's kind of where we stand at this point. We're still the preeminent force in world pork markets. This is the place that can raise pigs and convert them to pork and ship them to high-value markets better than any place else in the world. I still think we have a definite competitive advantage there. We're smaller. That was a foregone conclusion 5 years ago when we put our biofuels policies into effect. Lower output in the short run, we're going to have fewer producers, and I think it's going to drive at least some move toward more vertical integration as packers try to make sure they have suppliers for the pigs that they need. Also, all the problems we've had in trading wean pigs on cash markets and through contracts, I think is going to drive some vertical integration back toward farrow to finish, a pattern that had been reversed in the last few years. Profits are back after this long period of loss. This is the Iowa State estimates of farrow to finish operations in Iowa. June and July are about $27 per head. May was almost $40. That's going to go down seasonally as we go through the fall, but as I'll show you in a moment, the forecasts right now are that given futures prices yesterday, there shouldn't be, we should be in the black all the way through the fall, which that's not that common of an occurrence. And so that's good news. If we can get through the fall, that'd probably set us up for profits most of 2011 as well. Here is kind of a measure of producers' financial standing. If you sold 1 pig per month and put the profits in a bank account, this would be the balance of that bank account. I always tell bankers when I'm speaking to them, paying 0 interest, which is about what bankers normally pay on savings accounts. But it peaked out at about $800 back in September of 2007. It went down to $140 in May. We've already recovered back to $280. Right now, as of yesterday, the futures say we'll be back to almost $500 by mid next year. So we will have recouped over half of the losses in just about 15 months. So not a bad bounce back here, and I think we're going to keep gaining on that for the rest of the year. I only had futures markets out through July when I put this chart together. Slaughter down, as I pointed out a while ago, down 2.5% from what we thought it was going to be. This red line is my forecast of weekly slaughter based on the June Hogs and Pigs report, and you can see the last 2 weeks have been very short. We thought they were going to get very short starting in August here when this 50 to 119 pound category in the June pig report came to market. It was quite small, a lot smaller than any of the other categories. The talk I've heard is that this fits pretty closely with when we started feeding some 2009 corn crop to breeding herds last fall and may have had some real reproductive issues. Is there anything to that? Is that maybe one of the reasons we've been so short the last couple of weeks and might remain so? I don't know. I know that we had some problems in some places that got some moldy corn or toxin corn, but normally those are pretty well confined. They usually aren't big enough to have market impacts, but still, you have to kind of sit up and take notice when you come up that much short of an expected slaughter level. Now, we've made up for these slaughter reductions to some degree by weights. I tell folks, if you'd have told me last spring that our average market weights this summer would be higher than they were a year ago, I'd have told you you were nuts. Because last year it was such great weather in Iowa to grow pigs. Well, it looks to me like slack facilities trumps good weather. That seems to be the deal here, because I think really what we've had is we've had profits available, and so an extra pound made you an extra buck, and you've had room in some finishing buildings to leave pigs a little longer on feed and put that extra weight on them, and so that's exactly what's happened. But we've been above last year's all but 1 week this summer, and we were equal to that weights then. Will we see some decline here in the most recent 2-week period? We've had a lot of heat in the upper corn belt that we had not had before then, and so we might see some reduction of weights, but still, in general, at least as high as last year. Production down 3.5% per year, for year to date from last year. We knew that was going to happen. It's smaller than the reduction in slaughter because of this weight issue, but still, that normally would be 8 to 12% up on prices. But if we look at what prices have done, they've been 30% higher most of this year. So that relationship of the change in price versus the change in supply is really a bit out of kilter in our favor. We've had a nice rally here in August. I think that's over. We've been down below 80, back down in the 82 to 83 range most of this week. We're probably in the seasonal downturn going into the fall. I don't think it will be nearly as large as last year's seasonal drop, or the 2008 seasonal drop, and of course last year about anything's better than that. And so we've had great prices. They're going to break into the fall, but right now the futures indicate that they're probably not going to get below break-even levels. Why the discrepancy in the prices versus quantity? I think the biggest thing is we're comparing to an oddball year last year. It was depressed prices all year in H1N1's aftermath. Those high weights driven by unusual weather kind of created an unrepresentative base for prices to compute from this year. And then we've also had this positive impact of other species much of the year. And finally, we've had an economic recovery that, at least for the spring months, meant a real recovery in food service. Now that has faltered a bit the last couple of months, but still it's certainly better than it was. Yesterday we got export data for June up 22% from a year ago, well along this line of the 04 through 07 trend. I did some calculations last night, and what I came up with was, if we can run 17% above a year ago for the rest of the year, and the last 2 months have both been larger than that, we'll break the record for annual exports that we set in 2008. And we don't even have to be that high to break the record for the percentage of our production that we're exporting, because production is lower now than it was in 08. We're going to go over 20% on exports almost certainly this year. Now, some of you say, well, that's good. And others are going to say, the old Archie Campbell routine, no, that's bad. Okay? There is risk when you get that dependent on export markets. We saw what happened last year when a couple of key markets back out. So we have to balance that risk with the obvious reward of being able to sell more product in foreign markets. A lot has been made about, well, the weakening U.S. dollar will really help us here. I don't think that's going to be the case. And the reason is it's not weakening against hardly anything, strengthening, is going to hurt us. It's not strengthening against anything except the euro. If this is our other two major competitors' currencies, the Canadian dollar and the real, hardly any change there. If we look at our customers' exchange rates, here's the peso, and of course it's taken a few less pesos. The peso's strengthened a little bit relative to the dollar, and I wish I'd quit doing that. And then I went too far. Here's the yen. It's strengthened a bit. So has the yuan. And of course the Chinese renminbi doesn't change at all because they peg it to the dollar. Now, they have announced recently that they're going to start floating it or changing it a bit. You can see they went through a period of when they let it gain value over 04 through 07. They've held it steady during the economic crisis. Still, it's debatable what the Chinese currency would do if it was allowed to float. Virtually everyone thinks it would strengthen pretty dramatically. What does that mean? Well, that'd be good for us because it adds buying power for Chinese consumers. It'd be bad for them because it makes their goods more expensive in international trade. Given the fact that it's bad for them, I'd say you can conclude very safely that the Chinese aren't going to do that. And they're not going to do it, and they have no incentive to do it until the world starts forcing them to do so. I heard a guy say one time they will never become an economic power with a pegged currency. And I said, well, they're doing a pretty darn good job of it, if you ask me. So, but still, this is an issue that affects a lot more than the pork industry of the fact that the Chinese currency is overvalued. It should be allowed to float at some point, and if it does, undervalued. You can tell these are a little confusing. It's undervalued. It will gain value if it's allowed to float. That would be really good for us as an exporter and not good for the Chinese economy. Here's exports by destination. Japan, after a couple of years of kind of lackluster performance, we've had 2 record months in Japan in April and June. And a lot of that is because of the foot and mouth disease situation they had in parts of their pork industry, and so they had to turn to imports for some of that. Mexico is significantly higher than a year ago. Of course, this dip was caused by H1N1 and the demand effects it had in Mexico, but still, Mexico a solid number 2. Number 3 is still Canada. This kind of aqua-colored line right here that went to 0 early this year is Russia, and of course it's coming back, even though June was down a little bit from May. Now, the one to talk about, obvious, Tom got it. This is made for somebody with skinny fingers. That ain't me. It's China. And China and Hong Kong drove the situation in 2008, and here they are in 2009 or 2010. We were talking to dinner last night. Well, what's China going to do? 1.2 billion times any number is a great big number. Okay, that's the principle. It's always important to remember that. But they're still run by communists, and we need to remember that too. They are not going, in my opinion, and I think the evidence is pretty strong, that they are not going to become dependent on somebody else for something as important as pork. They've spent billions of dollars to revitalize their industry after the death losses of 06 and 07. They were in the market in 2008 for 2 reasons. One is they didn't have enough pork because of those death losses. And number 2, they didn't want 1 billion Chinese marching in the streets when everybody was looking, during the Olympics. They are not in that situation now. They're still going to be a customer, don't get me wrong. And they're going to be a very good customer for things like variety meats, which are very low value on the U.S. market and add value to your pigs just the same as loins and tenderloins do. But is China going to be this or this? My guess is somewhere in between. But not the juggernaut market that some expect them to be. I just don't think that's going to happen under the current regime that's there. Now, will they be able to feed themselves? That's the other question. They like pork. They eat almost as much pork as we do. Per capita. And they have a lot more people. But will they be able to feed themselves? Dermot Hayes says no. He thinks that we're going to have a growing market there, and I tend to agree with him. We'll have a growing market, but will it get huge? They average about 70 bushels an acre on the corn that they raise. Now, just using some new hybrids and some new techniques, I would think they could get a lot better in a hurry and raise more pork for themselves in that fashion. But still, this is still a debate. We'll see how it comes out. It's going to be politics, maybe against needs. Gene, do you have a question or a comment?
Where does Korea go, do you think, if the free trade agreement is authorized?
Somewhere up here.
That high?
It would certainly be number 3 and would possibly challenge maybe even Mexico sometime. Korea, I mean, Dermot says that he could add $10 to the price of a hog. And one fully implemented, I think, 7 years out. Whoop, it's a big deal. And, that's one place politically we need to really call the Obama administration to task. They've said they want to get it passed, then get it passed. I think it's lip service because I still think the auto workers and other unions are calling the shots on that deal. But it's a big deal. It would be really good for our business. Here's the index of demand, consumer demand, a real concern, down 4.5% versus 12 months. But here's the reason. All during this time of high wholesale prices this year, retail prices, according to USDA, had barely moved until May and June. And they set records in May and June. Notice, beef is close to a record, choice beef, all fresh beef. Chicken, close to a record. Turkey, pennies away from a record. Okay? And they're all going to start going up because we're finally getting all the cost increases pushed through to the retail level. And we're going to have record high meat prices. I just did an interview this morning with a guy in Kokomo, Indiana that was wondering why bacon was so expensive. And I told him it was because the ethanol he was burning in his car. Okay? Well, and it is. I mean, it really is. It's that usage based on corn, and eventually consumers have to pay all costs. Okay? And we're going to hear more of this. I'm going to get more and more calls about high-priced pork. You're going to get more and more pressure about high-priced pork. And Gene, what did I say 3 years ago? One of these days, they're going to discover high-priced pork, and by the time they discover it, they're going to blame you and not what really caused it. And I'm still concerned about that. Sow slaughter down 10 to 20% versus a year ago in June and July. But one of the reasons is we had a huge surge in sow slaughter last summer as a few large operations started liquidating and some small operations threw in the towel last summer after long periods of losses. So you always have to be careful about what you're comparing to, but it looks like we're settling in here at about 55,000 head per week. That's already cost us 2 sow kill plants. I know there's one in North Carolina that hasn't operated this summer, and Bob Evans announced last Monday that they are going to close the one in Galvin, Illinois. You will hear more of that. We have capacity to kill 100,000 sows a week, and we only have 50,000 sows to kill in them. There's not going to maintain that kind of capacity for very long. I think we're going to lose more of those plants. But as a percentage of the breeding herd, we're not that out of line here. And if we look at gilt slaughter, the blue line, this is a busy graph, I know, but focus on the blue line and notice that it is almost always above 49.5%. I have a missing observation there that I finally got this morning, and it was 51.1. Okay, so that means that the gilts are an unusually high percentage of total barrel and gilt slaughter. You can't build a sow herd if you're killing enough sows and you're not retaining gilts. There's just no way to do it. I don't think we've started doing that yet. And so we're still reducing these sow herds. We'll get Canada's July 1 data here next week. It's going to be down from a year ago again. And so this total is going to be getting down toward 6.5 or 6 million sows pretty quickly here. Here we are. This is percentage changes. The Canadian herd started reducing back in 2005 when their dollar really gained value. They're going to still be down 5 to 6%, I think, on this most recent report. We were down about 4%. We've reduced the North American sow herd by almost 8% in the last 2 years. Okay? So fewer and fewer breeding animals. Imports from Canada, and here I have to apologize because the last data we have is the last week in June. APHIS counts these hogs as they come across the border, and I know there are veterinarians here, but I think those veterinarians for APHIS are very numerically challenged or something, because every now and then it gets all screwed up, and it's happened again. These 2 observations here are probably wrong, but they haven't got them lined out yet, and so hopefully they will. I talked to AMS this week, and they said, we're trying to work through it. And I said, okay, well, we're 6 weeks out. We'd kind of like to have some data. Here's the Iowa State model as far as forecast on costs and futures as of yesterday, and you see the price stays above the cost line. Cost somewhere around the $66 range. Forecast for 2010 right now is for profits of about $13 per head the first half of next year, almost $20 for the first half of next year. And if you put in kind of a normal fall decline, you're going to be well over $10 a head in the future. Now, somebody said, well, boy, that was a lot better than that just a few months ago, and it was when futures were higher and corn was cheaper. And the only idea I want to put on that is this. How much outside money will $20 a head attract to the pork industry? How much outside money will $40 a head attract to the pork industry? Okay? I think over the long haul, we're all better off at 20 than we are at 40. Okay? Because there's a lot of stupid money out there that's earning virtually nothing right now that could flow into this industry if it's offered enough. Maybe slower than it has in the past. But, getting rich slowly still leaves you get rich. All right? Let's remember that. And it might be a good process to follow. Okay, here's my forecast for slaughter for this year, the rest of this year, and the first half of next. I've got it down 3% these next 2 quarters. I've got some growth as early as January. The other analysts do not have growth in the first half of next year. The reason I do is I think this trend for pigs per litter is going to continue. We're growing at 2% per year for the last 3 years. We went back to that trend in the most recent report. We still have room to grow. I mean, we're still not to 10 yet as an average for the country. We could go to 11 at some point pretty easily, I think. And so I think this productivity is going to bring us out of this reduction in supply rather quickly. If we look at price forecast, I've got third quarter, it's going to be pretty close. I thought at one time I was too high, but it's gotten back up into the 80s. We're going to be right in this range for the third quarter average. Down about $10 for the fourth quarter. A little lower I've got in the first quarter of next year, and then back up in the mid-70s. Here's where futures were as of yesterday. And you can see for the first quarter of next year, fourth quarter of this year a bit, but especially the first quarter of next year, those are above what I think cash prices will do. And to me, that says do some hedging. I mean, hedge 25, 30%. Hope you're wrong on them. All right? Because you're locking in profits in all of those quarters. And if it gets better, you're going to be better off, but at least you cover yourself. And it's especially true if your balance sheet is still not particularly strong. Questions about outlook? How much time we got, Ron? Ooh, boy, this is going to be fast on the Gypsy Rule. Okay. He said you didn't need a break. Okay. Isn't that what you said? Oh, okay. That's what I thought. Is anybody awake? If I'd tell another joke if I knew one. By the way, I did tell somebody this morning, we have 3 colleges in Iowa. Iowa State, Iowa, and Northern Iowa. Iowa State's underwater now. Iowa was underwater 2 years ago. Northern Iowa is the school that trains a lot of our teachers, and I can see why. They're the only one that had enough sense of not building a floodplain. But, that's what it is. Okay, let's talk about the Gypsy Rule. Now, as if I didn't have enough other things to do, USDA dumped this thing on my platter this summer and everybody else's platter in June. A proposed rule supposedly to enhance the ability to enforce the Packers and Stockyards Act and to make the market more fair. And that's right out of the rule. I'm not making that up. The genesis of this goes back to the Farm Bill 2008. Congress said to GIPSA, we want you to write some rules on 5 topics, and here they are. We want you to write a rule that says the criteria to be considered in deciding whether an undue or unreasonable preference or advantage has been given. I underline preference or advantage because it's important. It's kind of the positive side. Are they treating one person better than another? Conditions constituting reasonable notice of suspension of delivery of birds Obviously, that's not really our problem, but it is one of the 5, and it is specific to the poultry industry. Whether a requirement of additional capital investments are a violation of the Packers and Stockyards Act. And we've got to remember, contractors of hogs and poultry are subject. One of these days I'm going to learn to use that thing. Yeah, there, I got to buy drinks, I guess, or something. Okay. Iced tea on it for everybody. Contractors are subject to the Packers Stockyards Act. So if you have contract growers, you are subject to the Packers Stockyards Act. If you have one contract grower, you are subject. There's no size requirement. So these apply to a lot of people in this room. Whether a require of an additional capital investment is a violation of the Packers Stockyards Act. That is largely a chicken industry situation. I haven't ever heard of any situations with hogs, but it doesn't say that it only applies to chickens like the previous one does. Whether a reasonable time period is being given to remedy a breach of contract. Do you give enough time to take care of whatever problem that's happened? And finally, whether there's fair arbitration. Do producers under marketing contracts and growers under growing contracts have the opportunity to fully participate in the arbitration process? That's the way it was actually worded. So those are the 5 things Congress said go write rules for. The folks at GIPSA said, well, while we're writing rules, let's write some rules for a lot of other things. Okay? Let's take this opportunity. And so they went quite a bit beyond the Farm Bill. Now, somebody said, could they do that? And the answer is yes. Section 407 of the Packers and Stockyards Act gives them the right to write whatever rules they see necessary to enforce the Act. Now, the question is, are these rules necessary for enforcing the Act? And that's a legal question, not an economic one, but it's one that's been asked. They've started out by saying, okay, let's define some things. And one of them is a capital investment, whether that is new or additional. If it is $25,000 or more, it will trigger any of the restrictions regarding capital investment that are in the rules. So, how many of you, if you're doing work to put in a new contract sow barn or a new contract finishing complex, Zach, how long does it take to run through $25,000? You probably won't have a shovel in the ground yet, will you?
Absolutely not.
Okay? That's exactly right. It's a very low threshold. And so that's our real concern, is this just brings in anything at all. Now, again, this was really aimed at poultry growers, and especially chicken growers, who have repeatedly required facility upgrades, ventilation, feeders, water is what it is, of their growers in order to get another flock. And it's a symptom, in my opinion, of flock-to-flock contracting that they use in that business. Not a practice in our business in general. Okay? We've got a little more of that now, where we rent barns maybe on a turn-to-turn basis, but still, we've normally gone on long-term contracts. Marketing contract definition, it differentiates it from forward contracts. I don't see that as much of a problem. I think it probably brings some clarity to that issue. This one is a problem. Competitive injury, pure and simple, is an act that diminishes competition in the marketplace. Okay, and then it goes and lists some specifics there, and some of them could be used on a lot of things. For instance, if they have an exclusive dealing arrangement on a large portion of supply, well, define large. Okay, if I've got a contract with a guy to buy 150,000 hogs a year, is that an exclusive dealing arrangement? Those hogs are coming to me. They're not going on to the market. Okay, it's a little shaky. And from an economist standpoint, what is diminishing competition? I mean, if you read the rest of this rule, it seems to want to try to make one price, treat all goods exactly the same. And that says that they're thinking perfect competition or pure competition, which is a model that we use to teach economics, but it's not applicable to the real world because it has assumptions like homogeneous products, instantaneous adjustments, full and equal knowledge of all parties, many buyers and many sellers. Okay? Well, all 4 of those get violated all the time in the real world. So that's not a model that you could use, and yet that seems to be what they're saying. And the last point is most of the literature in livestock have looked at models and said there is some diminishment of competition. There is market power brought to bear by packers in buying hogs, for instance. And one of the reasons is they're big. I mean, they know kind of what happens to the market when they change a bid. It's not sinister, they just know, okay? But here's the kicker. That same size allows them to capture economies of scale that tend to offset any market power they exert in the marketplace. And this has been found in study after study after study, in the beef industry especially. Okay, this says if you diminish competition, that's competitive injury. It doesn't matter whether something else offsets that competitive injury. As an economist, I say, wait a minute, there's always a balancing here. You need to look at both sides. So this would kind of throw the baby out with the bathwater, that even though we have gains, we're going to throw it out because we have this loss over here. And the RTI study that Gypsy paid $4.5 million of our money to do found that exact thing. If you take out alternative marketing arrangements, contracts, packer ownership, those kind of things, consumers are hurt and producers are hurt and packers are no better off. Okay? So I have a problem with being quite so simplistic about this competitive injury idea. It needs to have at least the idea of an offset in there. It requires written records that provide justification for any price or contract term differentials. So if you offer a contract to someone that's different than the one you offer to someone else, you have to maintain written records of why that is different. All right? It doesn't say that they will accept anything that you write as legitimate, though. And it doesn't give you an idea of what is a good reason. It's just that you got to have records justifying. It applies to all swine production, poultry growing, and livestock production marketing contracts, even though some of the language of the law says it only applies to part of those. I don't know how you rectify that. This one is a real big one for me. It says that you can violate the Packers and Stockyards Act without a finding of harm to competition. That is, if you're in a contract dispute with a grower and they find that you have damaged the grower, that's a violation of the Packers and Stockyards Act, even if it had no impact on competition in the marketplace. 8 circuit courts of appeals, most recently in the Wheeler case in Texas, have held that's not the case, that this act is about competition, not about competitors. In addition, during the 2008 Farm Bill, both the House and the Senate committees took up the idea of including this in the Farm Bill, of saying you don't have to harm competition to violate the Packers Stockyards Act, and both of them said, no, we're not going to do that. They left it out of the Farm Bill. So a couple of weeks ago, when J. Dudley Butler, the administrator of Gypsy, and his boss, Alvalos, were called to the House Subcommittee on Livestock, Poultry, and Dairy, those congressmen were really interested to know why they thought they should write this law instead of Congress. Okay? And I would like to answer the answer to that same question. I mean, it is legislation by regulation. They've clearly gone against the courts and the Congress in what they've written here. And it doesn't surprise me because I know the people involved. I mean, the people involved at USDA in their previous jobs in Washington have all been on the side of this idea, and so they've taken this opportunity to just write a regulation on it. And I don't think that's the way government's supposed to work. It applies to contracts done after the effective date of the rule, but our attorneys say, yeah, but what about transactions after the date of contracts that are signed before? It doesn't really say anything about that. It defines unfair, discriminatory, and deceptive practice, the flip side of what Congress asked them to do. A number of things. Says an unjustified breach of a contract. We're all wondering what a justified breach of a contract is. If I knew, I'd breach a few, I think. I mean, if there's a justified one, let's know what it is. It said bargaining in bad faith. There's no definition. Retaliatory action by contractors. Probably a reasonable thing. I mean, if you go speak badly about a contractor, can he retaliate against you? I don't know. You know, there's some ideas there I like and some I don't. Any act or attempt to get a grower to waive any rights. Contracts are full of terms in which we waive rights to things. Attorney's fees, trial by jury, whatever, lots of things. This one says if you lay a contract in front of someone and ask them to sign it that has that in it, you've violated the act. You've attempted to get them to waive one of their rights. Undocumented price differences not substantiated by revenue or cost. So if you pay different for animals or for contract services, You have to document those and substantiate them on the basis of their impact on revenue and costs for them to be legal. Okay? Doesn't say you can meet competition. That's not in there. And see, here again, from the legal side, we have a rich literature of what is legal and illegal price discrimination under the Robinson-Patman Act jurisprudence over the last 100 years. And yet this one's redefining that and going away from it. Defines a more good definition, a termination of a production contract for violating a law unless the violation is reported immediately to the authorities. So if someone is violating, let's say, an environmental law, one of your growers, and you say, let's work on this and try to solve this problem. And a month later, you haven't got the problem solved, you say, I'm terminating the contract. You've violated the Packers and Stockyards Act because you didn't report them immediately to the authorities. You waive your right to terminate that contract for that reason unless you report them immediately. It says immediately. It's not very conducive to good working relationships. Fraud is an unfair practice, and I put duh. Any act that causes competitive injury or the likelihood of it, recall that diminishment of competition, any of that is an unfair practice under these rules. More about preference, contracts with price determined by volume must be available to anyone who can individually or collectively as a group meet the terms of that contract. So if I give you $1 because you're bringing me 5,000 pigs a year, if this group over here can bring me 5,000 pigs, I have to do the same for them. Doesn't matter whether the pigs are kind of all over the map or yours are consistent, I've got to do that. Do price premiums for quality, time, and delivery and production methods discriminate against any producer or group and could meet the standards? Now, in the discussion, they say that packers don't have to offer this for beyond their needs. For instance, if you only need 5 loads of pigs on hand early in the morning to start the kill, you don't have to offer the same deal to number 6, 7, and 8. Okay? But it doesn't say that in the rule. It doesn't say it in the rule. Is information about buying, handling, processing, and quality available to all? Packer practices. It prohibits a packer from buying animals from another packer or affiliated company. This one kind of came out of left field on us. We didn't have any idea this was coming. I think it's a cattle issue. There are a number of cattle that are traded from feedlots owned by one packer to packers, to different packers. Five Rivers sells some, is owned by JBS Swift. It sells some cattle to other packers. There's a packer in Washington that feeds a number of cattle in western Kansas. They're sold to other packers. Okay? I think it's that issue. And the reason is the hogs on this are reported and published separate. If you look at the 200 and 201 reports, you'll see a column that says packer sold pigs. That's pigs that are sold from one packer to another for slaughter. Most of them are Circle 4 pigs going to Clarity. Okay? That accounts for a huge portion of those. But they're reported separately, number, price, all the carcass characteristics, everything on them. Cattle doesn't have that. If you look at the cattle reports, there's nowhere in there where you can find those. They're put into the other categories depending on how their prices are determined. And I think that's the reason it's a cattle issue. But think about this. What about Smithfield's? Who's going to buy Smithfield sows? Or the ones owned by Seaboard or anybody else? What about the guys that own Triumph? It doesn't define what an affiliated company is, but I think you have to think that an owner of a plant's an affiliated company, isn't it? So that means no other packer could buy their extra hogs or their sows or their junk. Okay? If what it will do, a lot of people say, oh, it's just going to destroy the market. Well, no, it's not. What it's going to do is a golden opportunity for some guys to be dealers and brokers in between these trades. But the reason for this restriction is to keep packers from sending price signals to each other. Okay? That's the stated reason. Now, if I'm a dealer standing between Ned and Steve in a trade, do you think they're going to be able to send information to each other through me? One of them is going to say, well, tell him I'll bid 62 for those sows. The other says, no, by God, I want 64. Okay? Now, I'm going to tell the other guy. So is that going to stop us from sending signals? No, it's not. It really isn't. So this one's I think it's a boogeyman issue. I've really been campaigning with the cattlemen. Get yours reported as Packer sold cattle on the reports every day, just like we do, and I think we can make this go away. I don't know if they're going to do it or not, but I sure hope they do. It limits any dealers or buyers who serve as Packer buyers to working for only one Packer. This is a real problem in the cow kill business, where they go to a lot of different auctions to buy cows. A guy might buy for 5 different Packers. But do you think 5 different Packers are all going to send one guy to the cow auction? It's coal pig business too. That's right. So, again, one thing I do know about these rules, they were all written within the Beltway. The field offices at Gypsy, with all their years of expertise, never saw these rules. That's what I hear. So, kind of shows up. Each unique marketing contract must be submitted to Gypsy within 10 days. Now, I read this as saying, it says poultry production contracts and swine marketing contracts. It doesn't say hog marketing contracts. But I'll refer you back to that thing a while ago. It said that it applies to all of these contracts. So I don't know if I can split hairs that way. But you got to report it within 10 days. It doesn't say what makes it unique. Gypsy can post that contract on its website. It says it will redact any confidential or business information, but it looks like Gypsy gets to decide what that is. You don't. You have to notify them within 10 days of when any unique contract is no longer in use. I haven't figured out how you're going to keep this straight, to be real honest. So I think it's going to be a real record-keeping nightmare. Capital investment, any contract that involves capital investment, $25,000, has to be long enough for the producer, for the grower, to recoup 80% of their investment. So it dictates the length of the contract based on that. This is a discussion we had back in the 90s. There were people who say, well, those contracts need to be as long as the loan on the building. And I would say, okay, and what if the contract expires in 5 years and you can negotiate a better one? Well, okay. Now, that has usually been the case in the hog business. Now, it's probably not now, because we do have some excess capacity. But in the past, it has been the case that an owner of a building was better with an expiring contract if they were a good contract producer than they were with one that covered the length of their loan, because they had a chance to get a better deal. Again, it ties your hands. I don't think we want to do that. The criteria for a reasonable time of remedy of breach, it says you have to give them a written notice on initial discovery. But, by the way, if you wait 90 days, you waive all rights to terminate the contract because of the breach. Those seem to be they don't agree. And then some criteria for fair arbitration processes. And Phil Kunkel is an attorney who works for MP, the Pork Producers Council, and NCBA, and he's working on this project, said what this is a criteria for expensive arbitration processes, because they don't want you to use arbitration. I think really that's what it is. So, what are the impacts? Well, I think there's going to be several. One of them, homogenization. Now, I have put up here no premiums other than carcasses. There's nothing in here that says they couldn't find that carcass premiums are bad too. It doesn't really say that you're going to get away. I don't think they're after carcass merit buying systems, but you can't rule it out. Higher costs and risks of using contracts. I mean, you've got significant written documentation required now. You're going to have the possibility of challenge after challenge. Packers and stockyards includes a private right to action. Not just the government can bring a suit under this. An individual can. Okay? An individual thinks that you're mistreating somebody else can bring a private right of action here. Big difficulties for some packers and owners of packing plants. The whole concept of legislation by regulation bothers me. Forget about the hog industry. It bothers me as a citizen. Uncertainty and liability equal cost. They always have and always will. Variations in individual needs will be ignored due to required justifications. I mean, you're going to treat everybody exactly the same, regardless of what their needs or abilities are. For those who are good negotiators that work at it, this will work against them. For those that aren't very good a negotiator, they'll get the benefit of this without really doing anything. Likely to lead to further vertical integration. I think it's going to raise the cost of doing business with contracts. So it's going to increase the incentive to own your buildings and to own your pig supply. Now, does that mean we're all going to completely vertically integrate? No, but I think it will increase it. And what the really rub on that is if this happens, then the next action by Mr. Butler and Mr. Farrell and the group that are behind this will be to introduce legislation to ban or limit vertical integration. As a matter of fact, we've had a kind of an ongoing debate of are they just stupid and don't realize what this will do, or do they know damn well what it will do and that's really what their goal is? And most of the debate, we might be looking for black helicopters, but most of the debate is falling in the second camp. They're not that stupid. They understand what this is going to do, and it really gives them license to go beyond what they've gone already.